the same old subject keeps going on and on. We've got this recovering economy, and now maybe the market's too high. People are getting nervous, but then people are jumping in, and then we see these little side issues of GameStop and Bitcoin and all kinds of crazy things going on. Dave, what is going on? Can you tell our podcast listeners the economy what is going on?
Sure. So, I think that on the one hand, what's going on in the economy is all very positive. We're slowly but surely getting the virus under control. That is allowing us to bring things back online. And I think when all is said and done, we could very well see a 7.5% year from a growth standpoint, from an economic growth standpoint, which in real terms would be the most robust pace of annual growth that's been observed since the early 1950s. And so, the economy is certainly firing or on the cusp of firing on all cylinders here. And we think that by the fourth quarter of this year, economic conditions will be downright boomy. I would argue, though, that a lot of this good news has been priced into the market over the course of the past 12 months. I think the last time you had me on, and really for the better part of the last year, we were talking about how the market demonstrated this willingness to look through COVID because it was an inherently finite episode. And so I think, we're beginning to see what the market was focused on. And while we still see room for equities to trend higher into year end, I do think that you're going to see a bit more differentiation in performance. I think that what's been observed here over the past couple of months in terms of value versus growth, just to draw, very broad lines in the sand, could likely persist. Value seems to be pausing to catch its breath. Growth seems to be acting a little bit better, but we do think that over the remainder of the year, long-term rates will rise, and that will support the outperformance of value relative to growth. So still constructive, but becoming a bit more nuanced in our view relative to where we were, say, late last year or earlier on in this year.
So Dave, the question we get in markets like this is, maybe we'll have a correction, but do you think we'll have a major crash? Do you think the conditions are ripe for a big decline, 40, 50% kind of a decline?
So I think that a significant decline to the tune of 30, 40, 50% is probably a little bit of a stretch. I mean, taking a step back, right? The economy is recovering. Fiscal policy is supportive. The Fed could not be more dovish. And so I think that it would be challenging to see a big pullback in that type of environment. But I do think that as we get closer to, the economy actually being reopened, which we gauge is going to be sometime around the middle of the summer, you could very well see kind of a run-of-the-mill 10 to 15 percent pullback in equities. And what I would remind everybody who's listening is that, it sounds a little bit scary, particularly given we've had about 6 months here where we haven't really seen a meaningful pullback in risk assets and in equity markets. But that type of volatility is frankly quite normal. The average intra-year decline since 1980 has been 14.3%. And then more than 75% of the time, the market has gone on to finish the year in positive territory. And so I view, a pullback during the summer as a very healthy development and something that would actually set markets up for a pretty solid back half in 2021.
Nice. Your CEO was quoted in his recent letter in somewhat of a Goldilocks type economy, right? Is that
I think that's it's a reasonable way to kind of characterize the current environment. Everything feels like it's going pretty well. People know somebody who's gotten their shot if they haven't gotten their first one themselves. The economy is improving. We created almost 1 million jobs in the month of March. The Fed is easy, and there's more fiscal support coming in the form of infrastructure. So very much in that Goldilocks environment that we found ourselves in on a number of occasions over the course of the past decade. But I think it's important for investors to make sure that they're still looking forward and looking far enough forward to realize that while the good times may last here into the end of 2021 and the beginning of 2022, at some point here, we will return to the trend growth environment of 2% that we were in for the better part of the prior expansion. Now, that's not me saying that it's necessarily going to happen tomorrow, but more a recognition that eventually we get back to that steady state. And so for a lot of folks who are very enthusiastic about the value trade and cyclical trade, we still think it's important to remain balanced and not necessarily, stop allocating to those secular growth stories, but rather be a bit more balanced between the two as you think about building portfolios in the current environment.
Yeah, it sounds like it. Well, the podcast listeners might remember the reference to Goldilocks. About 15 years ago, we had a Goldilocks economy, not too hot, not too cold, but just right. But it might have actually related to the temperature of Jamie Dimon's porridge, maybe at breakfast. Nonetheless, Chris, did you have any?
Yeah, I was going to say, I think kind of along the lines of that, and one of the hot topics I think nowadays is inflation. How do you see that kind of representing kind of in the coming months? I know it's been really all over the news, and I think that's one of the fears that could drive that, 20%, 15%, whatever it is, possible pullback in the near term. So, what do you kind of see out there from an inflation perspective?
So when it comes to inflation, the real question is over what time period? And when we think about the long run, so call it the next 10 to 15 years, we really don't think inflation is going to be too much of a problem. We think that a lot of the structural forces that have weighed on inflation over the course of the past couple of decades, things like income inequality, demographics, globalization, the broad-based adoption of technology, all of this should continue to keep price growth pretty muted in the longer term. But we do recognize, and we actually saw the beginnings of it in this morning's CPI report, that inflation is going to pick up here over the course of the next couple of months, and then again into the end of 2021. And the way that I think about it is, over the April and May period, that was when inflation bottomed out in 2020. And so the year-over-year comparisons are quite easy, and that's going to make inflation look like it's running a bit hotter than perhaps is actually the case. We think inflation will settle back down over the course of the summer months, but it could very well remain north of that key 2% level before re-accelerating into the end of 2021 and the beginning of 2022. And the way that I think about it is inflation is kind of like economic sweat, right? If you go to the gym and you run on the treadmill for 20 minutes, chances are that you're going to perspire. The US is a 2% economy in the long run, but we're going to grow at 7.5% this year. And so one would expect with that robust rate of growth for a little bit of inflation to begin to show up. But again, we're very much aligned with the Fed on this one in terms of this inflation being transitory and longer term finding ourselves back in that environment that we were in for the better part of the post-GFC period.
Interesting. And I guess even playing on that a little bit, you talked a little bit about globalization. I know recently, especially, we've had some kind of geopolitical events, and we've seen from the international front kind of certain areas heating up. What do you kind of see from an international perspective coming into 2021 and even throughout the year coming into 2022?
So we're still fairly constructive on international assets and international equities in particular. We think that the dollar may not just blindly weaken into the end of this year. We think it's probably going to be a bit more range bound given how robust growth in the US looks set to be, and given that rates here are higher than the rest of the developed world. But even if the dollar is call it range bound, we do expect global growth to become increasingly synchronized. We do believe that the current administration is going to take more of a textbook approach to foreign policy than perhaps what we saw over the past 4 years under President Trump. And furthermore, when we think about the underlying fundamental drivers of growth, populations in the emerging world in particular are much younger than what we have in the developed world. And longer term, that should be a really nice tailwind for the overall pace of economic growth. And so we recognize that relative valuations are attractive. I mean, to be blunt, relative valuations have been attractive for the better part of the past 10 years, and that hasn't really mattered when it comes to performance. We do believe that valuations still are appealing, but the overall backdrop is becoming much more constructive. And that's what's driving a lot of our enthusiasm around international equities quite broadly, but particularly around EM and specifically Southeast Asia. That to us is a huge area of opportunity, particularly for long-term investors.